1998. Warren Buffett is about to spend $190 million on purpose to lose money. He knows every dollar he spends will produce a loss in year one. Wall Street thinks he's insane. But 5 years later, this money-losing strategy will make GEICO the fastest-growing insurer in America. Today you'll learn why the world's greatest investor deliberately loses money, how he gets paid to hold $23 billion he doesn't own, and why he runs a $57 billion empire with 12 people. Comment right now. What's your biggest question about Buffett's strategy? Picture the insurance industry in 1998. Every CEO is laser-focused on quarterly underwriting ratios, loss ratio, combined ratio, efficiency ratio. Wall Street analysts scrutinize these numbers like holy scripture. Beat the ratios, stock goes up. Miss by a point, you're fired. Then there's Tony Nicely at GEICO. He's spending $143 million on marketing, up from $33 million 3 years earlier. And here's the problem. Every new customer costs more to acquire than they generate in year one. First-year business is unprofitable. Massively unprofitable, so every dollar Tony spends on growth, it kills his quarterly ratios. Any other insurance CEO would stop. Would say, quote, "We need to protect our underwriting margins. We can't afford to chase unprofitable growth." Their boards would demand it. Their shareholders would revolt. Their stock would tank. Here's what most investors miss. They see GEICO spending massively on unprofitable customers and they think it's reckless. They see first-year underwriting losses and assume bad management. They compare GEICO's ratios to competitors who aren't growing and conclude GEICO is doing it wrong. They're looking at year one and ignoring years 2 through 20. It's like judging ocean navigation by watching a captain sail into the current. Looks like he's working too hard, burning too much fuel, making no progress. But he's positioning. He's getting to the spot where the current reverses, where the tide comes in, where nature does the work. But Buffett sees something else entirely. He's not looking at quarterly ratios. He's calculating lifetime customer value. And he knows that once a GEICO customer makes it past year one, they become incredibly profitable. Year after year, decade after decade. The lifetime value of one customer is 10 times, 20 times the acquisition cost. So he tells Tony, spend unlimited amounts on growth. Quote, "There is no limit to what Berkshire is willing to invest in GEICO's new business activity. Unlimited. Because the math works, because patient capital wins, because he understands something that quarterly focused competitors can never execute. He's about to teach us a 3-part system. How to harness currents that push you forward for free. How to ride tides that build momentum naturally. How to cut drag that slows everyone else down. These aren't stock-picking tips. These are business model advantages that compound for decades. The ultimate business generates capital from customers, invests that capital for its own gain, and gets paid for the privilege of holding it. Most businesses need money. Great businesses generate it. Transcendent businesses get paid to hold other people's money. Here's where investors completely miss the magic. They think businesses that require capital are bad, and businesses that generate free cash flow are good. That's correct. But they stop there. They don't understand there's a third category. Businesses that don't just generate capital, but that hold other people's capital, invest it for themselves, and get paid for holding it. Insurance is this business. Customers pay premiums up front. The insurance company invests that money. Claims get paid years later. The gap is called float. It's money you hold but don't own. A liability on your balance sheet. But here's what amateurs miss. If you have underwriting discipline, that liability is more valuable than equity. You think, quote, "But liabilities are bad, assets are good." You're looking at accounting, not economics. You're missing the current that pushes you forward without effort. The amateur owns a business that needs capital every year. The professional owns a business that capital flows into, like a river into the ocean. The professional asks one question about float. What does it cost? Most insurers pay for float through underwriting losses. They collect $100 in premiums, pay out $105 in claims and expenses. The -5 is the cost of holding that $100. It's expensive money. But Buffett built insurance operations with underwriting profits. Berkshire collects premiums, invests the float, and makes money on underwriting. The cost of float is negative. They're being paid to hold the money. Buffett stated it directly in his 1998 letter. At Berkshire, the news is all good. Our average cost over the 32 years has been well under zero. Think about that. 32 years of negative cost. They held other people's money and got paid to hold it. Then invested it in stocks and businesses. Double compounding, once on the underwriting profit, again on the investment returns. The professional doesn't just seek businesses that generate cash. The professional seeks businesses where customers deposit cash with you. You invest it, and they pay you for the service. Let me show you the numbers. In 1967, when Buffett took over Berkshire, insurance float was $17 million. 31 years later, in 1998, float reached $22.8 billion. That's growth of 25.4% compounded annually. But here's what matters. That wasn't just growth. It was growth at negative cost. Berkshire's insurance operations had aggregate underwriting profits over those 32 years. Every dollar of that $23 billion, they were paid to hold it. Buffett explained the math. Indeed, though our net float is recorded on our balance sheet as a liability, it has had more economic value to us than an equal amount of net worth would have had. Read that again. A liability more valuable than equity. Why? Because equity is static capital you already own. Float is dynamic capital that flows in, that you invest, that costs you nothing or less than nothing. It's leverage without cost. It's an ocean current pushing your ship forward while you sleep. The result? Berkshire compounded that float in stocks and businesses for 3 decades. Bought Coca-Cola with float. Bought American Express with float. Built an empire on money they didn't own and were paid to hold. But harnessing currents means nothing if you're rowing in the wrong direction. Because even with free capital, you can destroy value by chasing the wrong customers. That's where the second principle comes in. You need to ride the right tides. Great businesses can afford to lose money acquiring customers when lifetime value massively exceeds acquisition cost. But most public companies won't make this trade because quarterly earnings pressure forces short-term thinking that destroys long-term value creation. Here's how investors get this catastrophically wrong. They see a company spending heavily on customer acquisition. They see first-year losses. They see quarterly earnings taking a hit, and they panic. They sell the stock. They complain to management. They demand the company cut marketing spend to protect margins. They think losing money on customers is always bad. But they're judging an ocean voyage by the first 100 yards. They see the captain rowing hard against the current, burning energy, making slow progress. They don't realize he's positioning for where the current reverses. You look at GEICO spending $143 million on marketing in 1998. First-year customers lose money. You think, quote, this is destroying value. They should focus on profitable business. But you're ignoring years 2 through 20. You're watching the rowing and missing the tide. The amateur demands quarterly profit. The professional accepts short-term loss for long-term gain. The professional does lifetime value math. Tony Nicely at GEICO understood this perfectly. Acquire a customer in year 1 at a loss. Once they renew past year 1, they become part of the seasoned book, and the seasoned book was highly profitable. Those customers stay for years, often decades, low maintenance, predictable claims, high margins, so the math was simple. Spend $1 to lose 20 cents in year 1. Make $2 per year for the next 15 years. That's a 30-to-1 lifetime return. Buffett's compensation structure enabled this. 50% of bonuses tied to growth in policyholders. This explicitly encouraged acquiring unprofitable first-year customers. The result? Buffett told Tony, quote, "There is no limit to what Berkshire is willing to invest in GEICO's new business activity, as long as we can concurrently build the infrastructure." Unlimited. Because companies concerned with quarterly earnings would shy from these investments. Quote, "No matter how intelligent these might be in terms of building long-term value." Here's what riding the tide produced. In 1995, the year before Berkshire acquired GEICO, the company had 2.3 million policies and spent $33 million on marketing. 3 years later, in 1998, GEICO had 3.6 million policy and spent $143 million on marketing. Growth exploded. In 1999, the marketing budget jumped to $100. By early 2000s, GEICO would surpass $4 million. But here's what most investors missed. While spending exploded and first-year losses mounted, GEICO's complaint ratio in New York, its largest market, was not only the lowest of the 5 largest insurers, but less than half the average of the other 4. They were spending aggressively on growth and delivering superior service. The profit-sharing payment to all GEICO employees in 1998? 32.3% of salary. Quote, "May well have been the highest percentage payment at any large company in the country. They promoted 4,612 people in 1 year." That's the tide. Sacrifice short-term earnings. Invest in growth. Build an unbeatable position. Let the current of satisfied customers renewing year after year push you forward effortlessly. But even with free capital and customer tides pushing you forward, you can still drown if your ship is too heavy. If you're carrying dead weight, if bureaucracy creates drag, that's where the third navigation principle becomes critical. Bureaucracy destroys value by adding weight that slows the ship. The best organizations eliminate corporate overhead, decentralize decision-making, and let operating managers run their businesses like owners. Lean headquarters create speed that competitors weighed down by bureaucracy can't match. Here's what happens at most large companies. They grow, they acquire businesses, and they build empires. Corporate headquarters expands. HR department, legal team, strategy consultants, investor relations, corporate communications, internal audit, compliance, layer after layer of management, meetings about meetings, approvals for approvals, bureaucracy for bureaucracy's sake. The amateur thinks this is professionalism. This is what large companies do. You need oversight. You need controls. You need corporate governance. So they celebrate when the company opens a beautiful new headquarters building, when they hire a chief strategy officer, when they expand the corporate staff. But they're adding weight to the ship. They're creating drag. Every person at headquarters who doesn't directly create value is friction. Every approval process is resistance. Every corporate mandate is wind in your face. You think you're building a professional organization. You're actually guaranteeing you'll never catch the fleet competitors whose ships are streamlined. The professional asks, what value does corporate headquarters actually add? Buffett's answer at Berkshire? Almost nothing. Each operating business handles its own HR, legal, accounting, marketing, everything. They know their industries. They know their customers. Why would corporate, which knows nothing about furniture retail or candy manufacturing or flight training, tell them how to run their businesses? So Berkshire's headquarters in 1998 had 12.8 people. That's not a typo, 12.8. The .8 was someone working 4 days a week in accounting. Managing how many employees? 47,566. Managing how many dollars? $57 billion in net worth. Overseeing how many businesses? Dozens of companies, from insurance to candy to furniture to aviation. 12. Buffett joked about this quote. Alarming trend toward corporate bloat when adding a part-time employee. The overhead cost? $3.5 million per year. That's 0.006% of assets managed. Let me put that in perspective. A typical conglomerate of Berkshire's size would have corporate overhead of $300 to $500 million per year. Staff of hundreds or thousands at headquarters. Berkshire? 3.5 million, 12.8 people. The difference? That's $296 to $496 million flowing to shareholders instead of to bureaucracy every single year. Compounded over decades. But the real advantage isn't the cost savings. It's the speed. Operating managers at Berkshire make decisions instantly. No corporate approvals, no strategy reviews, no bureaucratic paralysis. Tony at Geico wanted to spend $190 million on marketing? Done. Ron at General Re wanted to expand globally? Do it. The Nebraska Furniture Mart wanted to build a massive new location? Build it. Buffett's instruction to all managers from his 1998 letter. Just run your business as if, quote, 1. You own 100% of it. 2. It is the only asset in the world that you and your family have or will ever have. And 3. You can't sell or merge it for at least a century. That's cutting drag. That's removing every ounce of friction between decision and execution. Let's bring this together. Buffett's genius in building Berkshire wasn't stock picking. It was understanding business models that compound naturally. The three-part navigation system starts with harnessing currents. Find businesses where capital flows to you, where you hold other people's money, where the cost of that capital is zero or negative. Insurance float, customer deposits, deferred revenue, negative working capital. These are currents that push you forward without effort. It moves to riding tides. Understand lifetime customer value and have the patience to invest for it. Acquire customers at a loss in year 1 if they become profitable for the next 20 years. Plant seeds knowing the harvest comes later. Most public companies can't do this. They're trapped by quarterly earnings. That constraint is your advantage if you can think longer, and it culminates in cutting drag. Eliminate bureaucracy. Decentralize decisions. Keep headquarters microscopic. Let operating managers run their businesses like owners. The weight you don't carry is speed your competitors can't match. This is why Buffett could spend $22 billion to acquire General Re and explicitly say, quote, Berkshire can add absolutely nothing to the skills of General Re's managers. There is a lot that they can teach us. He wasn't buying skills. He was removing constraints. General Re was a great business trapped in a public company structure that forced them to smooth earnings. That made them lay off good risks. That limited their growth. Berkshire bought them to remove those constraints, to let them write volatile business, to let them retain more risk, to let them grow without worrying about quarterly earnings. This is the difference between trading stocks and building businesses. The stock trader asks, what will the price be tomorrow? The business owner asks, what currents can I harness? What tides can I ride? What drag can I cut? One thinks in quarters. The other thinks in decades. One fights the ocean. The other becomes the ocean. Guess which one wins? So here's what I want you to do today. Look at any business you own or you're considering owning. Ask yourself 3 navigation questions. First, does this business harness currents? Does capital flow to it naturally? Does it hold customer money before providing value? Is there float or deferred revenue or negative working capital? Or does it constantly need more capital to survive? Second, does this business ride tides? Is management willing to sacrifice short-term earnings to invest in long-term customer value? Or are they managing to the quarter, cutting growth spend to hit targets, optimizing for today at the expense of tomorrow? Third, does this business cut drag? Is headquarters lean? Do operating managers have autonomy? Or is there bureaucracy, layers of management? Corporate mandates that slow decision-making? Most businesses fail all three tests. They need capital. They manage short-term. They're weighed down by bureaucracy. These businesses can still make money, but they'll never compound like the ones that pass all three tests. If you want to understand Buffett's complete business model philosophy, read his 1998 Berkshire Hathaway letter. The sections on GEICO's growth strategy, insurance float economics, and general structural transformation are masterclasses in thinking like a business owner instead of a stock trader. Free on Berkshire's website. No paywalls, no marketing. Just the best business education you'll ever receive. And if you want to go deeper, read every letter from 1977 forward. Buffett evolves from stock picker to business owner across these letters. You can watch the transformation happen in real time. If this changed how you think about business models, obliterate that like button. Subscribe for more deep dives into how legendary investors build empires, not just portfolios. And comment below, which of these three navigation principles do you see most companies completely ignoring? I read every comment. Remember, this video is for educational purposes only. This is not investment advice. Buffett's strategies require patient capital, long time horizons, and the discipline to think in decades while everyone else thinks in quarters. Always do your own research and never invest more than you can afford to lose.